All right, we're at the top of the hour, so I'm going to go ahead and get started. This is Steve Barnett. I'm SVP of Sales for Pegasus Technology Solutions, and I'd like to welcome everyone to our webinar today. This is with Pure, our great partner Pure, and it's True Storage as a Service that we're going to be discussing. For those of you who don't know who we are, Pegasus is a technology solutions company. We solve business challenges through technology, and our vision is for enterprise technology experiences for every company. And we do that through our Fortune 500 experience that we've garnered through years in this industry. And we have processes and methodologies of how we deliver that to all of our customers. And one of the business challenges that a lot of companies are facing today is when you're looking to buy new storage, particularly in a CAPEX model, a lot of times you have to try to forecast out exactly what your storage needs are going to be years down the road, and that is pretty tricky. I've worked with customers for years trying to make that happen, and it's never exactly what you think it's going to be. You're either buying too much or too little, and it's definitely an issue that all companies face. And then you have, if you're doing that, you're always looking for within that CAPEX purchase room to grow, those types of things. Well, Pure has developed a true storage as a service model, which allows you to buy only what you need today, but then have the capacity to grow exactly as you need to when your storage needs demand it. And here to talk about that with us today is Josh Petty. Josh Petty is Director of Portfolio and Solutions Marketing for Pure as a Service. And he's got an excellent presentation to walk you through exactly how Pure does that for us today. Josh, are you there?
I am. Can you hear me okay?
Sure can. Take her away, Josh.
Thank you so much. So we'll go ahead and get started. Again, thanks for joining today. We're very excited at Pure Storage and the Pure as a Service business unit to be able to partner with Pegasus to bring you something a little bit different and special. So we'll just dive right into it. To start with, let's talk briefly about what storage as a service is. So it's not necessarily a product, it is an operating model. It's very similar to the way we think about cloud computing. Cloud isn't necessarily a product or a vendor. Cloud is just a way of doing business and getting the infrastructure and solutions that you need. Storage as a service is the same way. It can be delivered entirely in the cloud. We see things from hyperscalers like Amazon Web Services and Azure, where they have these solutions for their off-premise in-cloud storage. But what we've seen also in the last couple of years, we actually launched this 2 years ago, was the ability to deliver storage as a service in your data center. So the one thing that we'll start with as far as storage as a service is it doesn't necessarily have to look different from a hardware perspective. You can still have a storage array in your data center, but managed as a service or delivered as a service. And you can put it elsewhere. It doesn't have to be in your data center. It can be entirely in the cloud. It can be, in a service provider or a co-location facility. That's one of the other hallmarks of storage as a service is it's cloud enabled. It should be really designed to be an on-ramp to the cloud for you, whether that's a hybrid cloud or public cloud methodology. The other thing about storage as a service is that it is elastic and consumed on demand. To put that in different terms, if we have an iCloud account for our Apple devices, you don't worry when you upgrade from 2 gig of storage a month to 10 gig that somebody's on the back end having to provision or upgrade some gear. We just always operate on the assumption that there's plenty of available capacity, and that's another hallmark of storage as a service, that elasticity. The other thing is, compared to traditional CAPEX purchasing, we deal with a lot shorter term contracts. So, for a customer that is, trying to get out of the cycle of being locked into a vendor, you can have contracts, as short as 12 months, depending on the provider. The net of it is that the financial and operating models change, but hardware locations don't necessarily change. So don't think of storage as a service as, I've got to push all of my storage to the cloud. You can still continue to operate in your on-prem and hybrid models. But we do see the storage as a service and as a service in general is trending upwards. This is some IDC research that points out that these consumption models give you clear alignment between outcomes and costs. This clear per unit pricing is a huge advantage for vendors, or sorry, for customers that are looking to have a little more predictable outcomes. The other thing is, by consuming as a service, you can reduce your CAPEX spend that can then be reinvested. So a lot of CIOs are realizing that moving more and more infrastructure to an OPEX-based model or flex consumption model gives them the capital and the time that they need to be able to pursue, real modernization. IDC was predicting that by 2024, half of data center infrastructure would be consumed or operated as a service. We're actually seeing that accelerate as a result of the global pandemic. Being able to preserve those cash and capital budgets while still getting the gear that you need and having budget available and time available to invest in the future has really accelerated people's move to these as-a-service models. What we're seeing now as a result is that over half of customers and CIOs are preferring an as-a-service delivery, whether that is on-premises or off-premises. So we're seeing a lot of momentum toward consuming these in a flexible model. Now the reason they're doing that is one, it's super flexible, not just financially, but also it allows you to be more agile as far as how you deliver these solutions. I saw a chat come in. Are we still good on audio and video?
Yes, we are.
Okay, awesome. I can't see the chat questions as they come in real time, so I just wanted to make sure that I wasn't I wasn't suffering from low bandwidth. Some of the other things that customers are looking at is preserving capital, having that smaller upfront investment, and also being able to reduce the total cost, not just the per gig cost of storage, but also the FTE hours required to support it. So the end result is that storage as a service is very attractive to a lot of customers, dealing with budget constraints, but also anytime you purchase a CAPEX asset, you have to size it and you have to forecast, and that introduces some risk. In most CAPEX purchases, your utilized capacity is very low up front, which means that there's waste. So you're either over provisioning, or if you don't get the forecasting right, there's a risk of under provisioning, having to rebuy before the expected end of the contract. So being able to just consume on demand, pay for what you use, makes it very attractive, along with being able to offload some of the IT staff workload. The other reason that it's attractive is that you get away from these hardware-based outcomes. So you don't have to pin the success or failure of a project on whether or not you bought the right storage array. Instead, what you're subscribing to is an amount of capacity and an SLA, which gives you much more predictable SLA-based outcomes that align with your business objectives. So storage as a service is growing. Customers are looking for those cloud-like or cloud economic benefits, and also the operational benefits that come from taking something that was normally a non-strategic activity, which is storage management, and being able to offload that and get an improved operational model. So the way it works, you can get anything, any Pure product through Pure as a service. What you see here is on top of the innovative things that we've done around the Purity platform and Pure One, our AI-based monitoring and management. We have our block, file, and object storage platforms. You can consume any of those platforms as Pure as a service and then build the same solutions on top. So you don't have to worry about there's a Microsoft SQL solution that looks really good on FlashArray. Can I deliver that as Pure as a service? Yes, if you can consume an application or a solution on FlashArray, FlashBlade, or Cloud Block Store, then you can get those things delivered as a service. So it gives you just a little more flexibility in how you go about procurement. So let's look at three ways or three leading influencers across the entire storage as a service model. So the first one is the customer experience. Storage as a service customers demand a very similar experience to what they get from a hyperscaler. They want self-service. They want to be able to set policies around how the equipment and software updates are managed. And they want that consistency regardless of location. So whether you move from data center to data center, between your on-premises and a managed service provider, you have a very consistent operating model. The one that we're most familiar with is cloud economics, and that tends to get the most buzz when we start talking about as a service delivery. Naturally, being able to consume on demand, getting that elasticity, being able to select SLAs and pay for it out of OPEX budgets, those are all hallmarks of a cloud model. And that's what we deliver with Pure as a Service, and it should be what all storage as a service strives to be. Finally, we'll look at cloud operations. So when it comes to, and I mentioned this before, storage management is a non-strategic activity, or hardware management specifically is a non-strategic activity. So a lot of customers, whether it's storage or infrastructure or even platform, they're realizing that if I can get the people that built it to operate it for me, I'm going to get a much better experience. And I'm also going to free up time that I can then reinvest in skills training to accelerate these modernization efforts. So whether it's installation or ongoing management and upgrades, alert monitoring, forecasting growth, all of those operational aspects are then provided by Pure in the case of Pure as a Service. So these are really the foundational reasons why customers are making this transition to Pure as a Service. It's the experience that's more like a hyperscaler. It's the improved economic flexibility, and then the operational benefits. And we'll step through all of those in a little more detail. So what we're asking you to do today is to rethink ownership. Historically, we buy a storage array, we use straight line depreciation, and at the end of 3 to 5 years, we end up replacing that array or upgrading it. Rather than doing that, let's talk about how we can not own the gear and still get the same benefits with Pure as a Service. So Pure delivers block, file, and object storage as a service. It can be on-prem, so if you've got a single site with storage requirements, you can use Pure as a Service and we'll put the hardware there. If you're using a hybrid cloud, then we can either put virtual hardware in the public cloud for you to use, or in the case of a colo or an MSP, we can even put physical hardware there for them. So that regardless of where you deploy your workloads to meet business needs and outcomes, you're able to do that all with the same platform and all with a unified subscription. So all of the sites, whether they're block, file, object, on-prem or off, all roll up into a single unified subscription. So you get one bill for all of those sites and very clear per unit costing or pricing, which makes it very attractive to architects that are doing long-term planning for projects and want to know exactly what the costs are going to be 24 months down the road. All the way to the CIOs who are trying to simplify the procurement process. With Pure as a Service, it is a true OPEX-based service. There are no assets that a customer has to worry about owning or depreciating or updating, doing upgrades. All of that is handled through a single OPEX-based service. You pay for what you actually use rather than what is provisioned. And we can elastically scale that based on our non-disruptive operations. So over time, if we need to add capacity to your environment, whether that's on premises or in the cloud, we can do that. If we need to do software or even multi-generational hardware updates, we can do that non-disruptively. The other thing that we offer is short-term commitments. So you can get started with Pure as a Service for as little as 12 months to try it out for a project, and then see where it goes and potentially migrate even additional workloads onto it. You can also use it as a bridge. So if you're traditionally a CAPEX purchaser, but you're finding that as a result of the pandemic, budgets are either strained or gone, then this is a way that you can get what you need temporarily, migrated onto Pure as a Service. And then at the end of your contract, you can use some of our technology to actually move that back to a CAPEX purchased array. And we'll cover that in a little bit more detail later. But the idea is whether it's pricing, operations, or consumption, it's a very, very flexible model that allows you to tailor your storage experience to exactly what you need. Now, there are a lot of customer or vendors that have come out recently with as-a-service models. Most of the large storage hardware manufacturers have done that. Pure as a service is very unique. So for one, it's the most mature offering in the market. We launched 2 years ago and we're the first to market with a real as-a-service product. So we've got a lot of history in how to manage and operate this that you may not get from another vendor. The other thing is, though, it was the previous innovations that allowed us to build this. We didn't try and take an existing storage array and then retrofit it and build all of the kit necessary to deliver it as a service. Fortuitously, we actually had a lot of that already built. So with Evergreen Enterprise technology, you get the non-disruptive upgrades and the ability to keep storage fresh on an ongoing basis. Without that, it would be very hard to deliver elasticity or being able to expand and contract the physical footprint in response to the demands of the organization. So we really had a stroke of luck in that having already built that, it gave us the foundational elements necessary to deliver storage as a service. The other thing is our Pure One AI-powered monitoring and management. Now, this extends into all areas of our service management. So that includes alerts and monitoring, as well as forecasting and prediction to figure out when we need to come out and add additional gear so that you never run out of storage. From a management orchestration perspective, because it's flash array, it's FlashBlade, it's cloud block store, you get to leverage the full APIs and orchestration tools and integrations that are delivered for those products, but you get to consume it as a true utility. So these are all some very fundamental differences between Pure as a service and some of the other vendors that are out there. So let's talk about the thing that we normally headline with, which is the economic benefit, because honestly, that's one of the easier things for the industry to recognize as a value here. The trends that are driving it are obviously cost optimizations. People are looking to get their costing in line with some level of predictability. So per unit pricing through Pure as a service allows customers to do that. The other thing is, even if I wanted to put some things in public cloud, there are limitations. They might be performance related. It makes more sense to have an array in my data center to support those workloads. It could be compliance reasons. There are some workloads I just can't put into a public cloud. So if I'm trying to avoid depreciation, I'm trying to save cash and get a faster time to market, time to insights, but also I can't necessarily do that with public cloud, then Pure as a service is a great option to be able to get the storage you need in that same familiar cloud economic environment. So with Pure as a service, you pay as you go for what your host actually writes to storage. So instead of having lots and lots of over-provisioned capacity so that you can grow into it, your costs reflect point in time what you're actually using. So you never end up paying more than you should for the storage requirement. Now, if we compare current state of a CAPEX purchase to a Pure as a service deal, with a CAPEX purchased array, obviously you own the asset. So after 6 months, you might have migrated some workloads. You might have some seasonally variant workloads or test and dev projects. In this particular example, let's say that 35% of it is continuous usage, 20% of it is variable usage that those projects and seasonality bounce into. And then you've got 45% unused capacity set out there for multi-year growth. You've paid for it all up front, so all of that, whether it's used or unused, represents cost, and it's all CAPEX cost. Now, when we compare that with Pure as a service, the same exact workload still can be hosted on an array in your data center. So from a CAPEX perspective, the hardware is the same. It's still in your data center, so locality is the same. The difference is that in this case, you're only paying for the 35% that is ongoing usage, and you're paying that at a discounted rate. And that 20% variable usage is consumed on demand. So as you use it, as those changes or as the workloads ratchet up and down, you only have to pay for what you actually use, and that's all OPEX cost. Now, the other 45% that would have been over provisioned and unused in our CAPEX model is still there for you to use. The difference is that you're not paying for it until you actually use it. So Pure is carrying that cost of even the on-premise gear while you ramp up and grow into it. Now, a couple of concepts that we'll talk about, and if you reach out to Pegasus and the Pure team to put together, a quote to see what your environment might look like, these are two concepts that will be included. So one is on-demand usage. The orange line here represents what your workloads would actually consume. So you can see that grows over time. Some of it bursty while you're doing migration, and some of it is organic growth over time. We measure that 3 times a day, and we bill it at our standard rate. So there's not a punitive cost for getting into on-demand usage. And that's billed in arrears, either quarterly, or if it makes sense, it's billed monthly. Now, on top of that on-demand usage high watermark, we maintain 25% headroom. And this is where the elasticity comes in. So you've always got the capacity to be able to burst 20-25% above your standard consumption. And we track that over time so that when you start to get within 75-80% of capacity, it triggers a shipment so that we will go out and put additional capacity on the floor, whether it's in your data center, in a colo, an MSP, or if it's just a billing adjustment for public cloud. But you never have to take downtime for those capacity expansions because of Evergreen. And this is what I was talking about a little bit earlier. Those previous innovations really led the way for us to be able to deliver this elastic environment. Now, if there's an amount of capacity that is going to stick around for a while, then you can reserve that capacity or commit to that usage over your contract and purchase it at a discount rate. So that discounted rate changes, as you commit to more, then you get better discounts over time. And you can raise that reserve capacity at any point during your contract. So this allows you to start small and then grow into it over time and manage costs. Compare this with some of the things that other vendors are doing in the industry. They're asking for 3 to 4 year commits up front. And it's really more like a standard lease when you think about the costs. And in some cases, financial accounting has to recognize it actually as a lease. Because this is a service, you can commit, raise that reserve rate at any point, manage your own discounts, and at the end of a term, you can even lower that. So if you've got workloads that are coming offline or migrating to public cloud, at the end of the term, you've got the ability to reset that reserve commit. So it really puts the flexibility in your hands to be, as a customer, to be able to manage your own costs and not have to deal with the risk of forecasting. Again, what we typically recommend is that you size that reserve commit for what you're going to use in the first 6 months, and then reevaluate at the end of 6 months and figure out if you need to raise or lower it. But even in month 1 or month 2, you can come in and raise that reserve commit to get the best discounts possible. From an accounting perspective, there's nothing to own or depreciate. It's not like a capital lease. And you can use that on-demand coverage or that on-demand availability as a flexible burst capacity for these seasonal workloads. So you don't have, if you're a financial service company that has peak workloads in March, April around tax season, or if you're a retail manufacturing business that has peak workloads closer to the shopping season in the fall, you don't have to have permanent capacity expansions to be able to support those workloads. So whether it's cost or operational, it gives you the flexibility needed to be able to get the storage that makes sense without breaking the budget. Now, another thing that we'll talk about real briefly as it relates to leasing, there were some changes that came out from FASB and IASB, the two major accounting standards boards, that limit what you can recognize as an OPEX cost and also limit what you can keep off of the balance sheet. So for instance, if the lease terms are more than 12 months, which we know most storage leases are, then it requires you to recognize those assets and liabilities, which essentially turns it into a capital lease that has to be depreciated and handled in the same manner as other, capital expenses. The other thing is that to classify a lease, or it classifies a lease if it depends on the use of an identified asset. Pure as a Service does not use identified assets. Most utilities use an identified asset. But with Pure as a Service, you're committing to a capacity and an SLA, not a particular storage array. And we come in and we make those adjustments to the arrays, upgrade controllers, sometimes replace controllers to make sure that that SLA is always delivered for you. But it's not, I've yet to run into a customer whose accounting team wanted to classify this as a capital expense. It typically falls into an operating expense. So again, with leases, you've got that 3 to 5 year life cycle. So if you're looking for something that is, transparent, that has shorter term contracts, no identified assets, then Pure as a Service very well may be the solution that you're looking for to be able to deliver storage in an OPEX based model and keep those assets off the balance sheet. So no webinar would be complete without some discussion of total cost of ownership. Because Pure as a Service owns the gear, it's more of a total cost of non-ownership. So we'll give you a quick example. This is a customer that's looking to hit a target of 500 TIB over 6 years. So what you can see here is that after a year and a half, they did a capacity expansion as their usage got very close to hitting full capacity on the array. But over time, the usage ramps up gradually. There's a migration period, and then there's organic growth. So you don't use all of that capacity from day one. Now, as a result of that, because with a CAPEX purchase, you do have to spend all of that money up front. You pay for the capacity expansion, and then at the end of year 3, you've got a maintenance renewal. At the end of year 6, you've got another maintenance renewal, which drives the CAPEX costs up. When we compare that to Pure as a Service, because you're paying for what you use as you go, your cost per utilized gig is actually about 20% less over the course of the contract than if you had delivered the same thing via a CAPEX purchase. Part of the reason for that is that there's a net present value improvement. So net present value is all about, if I save $1 million this year, it's better than if I save it 5 years from now, because from an investment or buying perspective, that $1 million is worth more this year than it will be in 5 years. So when we take into account that I'm paying less with Pure as a Service upfront, and over time, I'm basically hitting cost parity with a CAPEX purchase, then it creates this environment where I've got savings, even though my cumulative total spend is about the same, my cost per utilized gig is less, and I have a net present value improvement. So CFOs and finance procurement folks love this because it frees up budget and it gives them more near-term purchasing power to be able to pursue those data center modernization projects. So let's shift gears slightly and we'll talk briefly about cloud operations. So with Pure as a Service, you get the same solutions you would normally get from Pure, but you get them in a pay-as-you-go model. So you can still deliver containers, converged infrastructure, DevOps, remote workers, virtual desktops. You can still deliver the same applications because the gear is the same, but the ownership and procurement model is different, which allows you to greatly simplify the infrastructure that you have to manage to support those applications from a storage perspective. The other thing that it does is aligns the costs more easily with applications. So you've got a clear per unit pricing for what you're actually using. So it makes it very easy to scope things like SQL replatforming or SAP environments. You know exactly what those applications are going to cost based on that clear per unit per gig pricing. Finally, from an app perspective or operations, you've got elastic availability, which plays into data protection and business continuity. It plays into rapid restore, and we'll talk about some of those scenarios in a little bit more detail shortly. But the net takeaway here is that anything that you can deliver on Pure hardware today can be delivered on top of Pure as a Service operationally. Now, here's what we do in the service to reduce staff workload, or kind of what do you get. We handle installation services. You can do that either remote, or we can do on-site delivery services. And our time to deliver is quite short. We typically target about 10 days for delivery. However, in most cases, it's, that I've seen, it's less than a week actually to be able to either get a new customer set up with hardware delivered or do a capacity expansion. Now, you never have to worry about the cost of those software or hardware upgrades because it's all contained in the management umbrella of Pure as a Service. So if you're scaling up and we're sending somebody out there monthly to put disk packs in, that's not something that you incur a cost for. It's all bundled into the cost of the service. You also can expect some improved security. So, one thing that we find in enterprises is that sometimes patch management and software upgrades, there's a little bit of a delay. With Pure as a Service, you can set policies around when you want those upgrades to happen. So if there is for instance, a security-based upgrade or, an improved security feature, you don't have to worry about your team staying on top of that and scheduling it because that's handled, managed, and coordinated through Pure as a Service. You also get the operational benefits that you would normally get from Pure One. You get alerts and notification. We do rate of change tracking so that if you start to consume more Pure as a Service, we can predict exactly when we need to ship additional capacity or hardware to you, and when we need to schedule the installation of that so that you never have an outage, but you also never run out of capacity. So this is a fundamental operational benefit that customers love, not being able or not having to worry about forecasting and ordering disk packs. They just consume, and the more they consume, the more we adjust and scale up the environment. So again, operationally with Pure as a Service, you can deliver it anywhere. You can deliver it on-prem in your data center, or if you've got a colo, a second location, or a hosted location, a service provider that you want to work with, you can use things like Active Cluster and CloudSnap to make sure that your data is where you need it. You can access it where you need it in the same familiar ways that you would access it on-prem. Within the public cloud, we can also leverage our hybrid connectors so that we can create that virtual infrastructure that mirrors what's on-prem so that you've got a consistent experience regardless of whether it's in your building, someone else's, or in the public cloud. So it's a lot of flexibility to be able to deliver exactly what you need where you need it to align with business outcomes. Now, if we take that a step further and we think about data continuity, most customers are running active-active data continuity or disaster recovery scenarios at this point. One of the beauties of Pure as a Service is because it's elastic, you don't have to commit to a giant footprint at your secondary site to be able to handle that failover. You can rely on that elastic headroom so that it's available if you need it, but you don't have to pay for it monthly in real time. So this is another way that you can reduce costs. You can get some improved flexibility about how much or how many and what types of workloads you can bring up at a DR site without breaking the bank and having to do a big CAPEX purchase to support that. Now, for customers, some of them, an as-a-service model doesn't really work. It might be because they're private equity backed and they tend to like straight line depreciation. Now, if what we've seen recently as a result of the pandemic is that even those customers are looking for temporary OpEx-based solutions so that they don't have to do a massive migration or a complicated migration, but they can temporarily preserve some CAPEX budget to a point where budgets are free enough that they feel comfortable buying another CAPEX asset. If you find yourself in that situation, then you can use Pure as a Service. If you've got an existing CAPEX Pure environment, we can do the migration to Pure as a Service. You can sign as little as a 12-month contract. And at the end of 12 months, if it makes sense to do a CAPEX purchase based on your budgeting, you can then make that CAPEX purchase and again use Active Cluster to migrate your workloads back, and then we'll come in and remove the asset. So the net of it is you've got the flexibility not only to do CAPEX or OpEx, but if you need OpEx just for a brief period of time to get back to a point where you can do a CAPEX purchase and straight line depreciate, then we have solutions for that can do it with minimal lift and not break the bank. So let's talk about the final pillar, which is the customer experience. When we compare buying a Pure array to consuming the same gear via Pure as a service, much of it is the same. You still get the benefits of Evergreen, you get non-disruptive upgrades and management, you get Pure One fault monitoring and correction. What you additionally get with Pure as a service is some flexibility to pull those assets off of the balance sheet, which can, depending on the gear, and then guarantee the SLA to your line of business stakeholders. All of that's handled by Pure as a service. So you don't have to forecast, you don't have to predict 3 to 5 years in advance what you might need. You can start small and grow into it over time. And that's really the message here with one of the final slides that I'll share with you, is the customer experience is much more like a hyperscaler than it is a traditional storage vendor. Being able to start small and grow over time greatly simplifies the infrastructure, and you can consume on demand. In fact, you can consume entirely on demand if you like, without having to make big upfront costs, with the exception of an installation or a setup fee. There's nothing for you to own or manage, so at the end of the contract, you don't have to worry about disposing of assets. We pick them up and take our toys and go on our merry way. So it makes things a lot easier for you as a CIO or as an IT professional to be able to mirror your costs with what you're actually using. The other thing is you get the financial flexibility that customers are looking for right now. You don't have to put the assets on the balance sheet. You're in control of managing your own discounts, so you can raise that reserve rate and purchase that capacity if you know, again, that you're going to use it for the entire term of the contract, and get discounts. So the more aggressively you manage that commit to your actual usage levels, the better the discounts you get. But it's all in your hands, so you can consume it or you can change it, modify it, manage your own costs as you need. The other thing is a short-term contract. So we're not asking you to lock into a 3 to 5 year commitment. You can start with as small as a 12-month contract. So this allows you to more easily align with outcomes. If you know a project is going to be a 12-month project, you can have a contract that covers storage to support that project. Maybe it's DevOps or a application dev project. You can support it just for the time that you think you're going to need it. If you need to scale up remote workers as a result of the pandemic, you can have a short-term contract and reevaluate in 12 months if a large remote worker volume is right for you. Again, you've got the elasticity to scale up or down. So as things change, that the infrastructure is always going to work for you. So these are some of the high points of the customer experience. Again, it's more like a hyperscaler experience because I know that it's going to be there. It's self-service. I can consume as much or as little as I want, but I've got clear per unit costing, which allows me to more easily respond to my line of business owners with clear costs and clear timelines for when I can deliver infrastructure for them. So that is what we had hoped to cover today. There's one other thing that I'll share with you. So for new Pure customers, we're also doing some promotions. So if you sign as little as a 12-month, 50 terabyte contract, we'll give you the first 3 months of that reserve capacity for free, which is designed to allow you to migrate workloads at essentially no cost or very little cost, and get them up and running within 3 months to finish out that 12-month contract. If you're interested in a 24-month contract, we'll actually do the first 6 months free. So if you're needing storage today and the budget just won't accommodate it this year for a capital purchase, you can look at Pure as a service as a way of easing the financial requirements in ongoing budget years, but also getting what you need today without having to pay for that committed consumption or committed capacity between now and the end of the year. So a lot of flexibility, a lot of options for our customers, and I appreciate very much the time, and I appreciate Pegasus for setting this up for us. So with that, I will stop my share and I will flip over to take some questions.
Thanks, Josh. Hey, really appreciate it. I do have a few questions for you. And for those on the call, I forgot to share at the beginning, we do have a Q&A button here at the bottom. If you want to ask some additional questions that aren't covered here with these that I have for Josh now. Josh, so the first one is, what are the minimums for Pure as a service?
So the minimums currently are 50 terabytes for file, 50 terabytes for file and object, 50 terabytes for block. The only outlier is that it's still 300 terabytes for our capacity file and object. So for the most part, you can get file, object, or block on a 12-month contract at 50 terabytes.
Okay, thank you. And the next question I have is, how quickly can the environment scale?
So good question. I can give you some anecdotal evidence. So again, you know, we target about 10 days to be responsive to a scaling request that's, you know, auto-generated within Pure One. Realistically, so I had one customer that they're a very large athletic retailer and manufacturer. They had to double the size of their VDI environment in the first week of March of this year. And we were able to double that entire footprint, which was pretty massive, in about 9 days for them. Another customer, we recognized that they were running out of capacity and alerted them to it. They had no idea. And 4 days later, we had the expansion in place so that you know, they had plenty of headroom to grow into. But yeah, anecdotally, we tend to commit to about 10 days, but the reality is that unless it's a very, very large project, we can typically get it done in about a week.
Wow, that's pretty quick. And then finally, can this be mixed with a Pure CAPEX environment?
Yes, so your Pure as a service contract is capacity based, and it's independent. So if you've got Pure storage arrays that you've already purchased that you're straight line depreciating, you can also use Pure as a service to augment those and gradually, you know, migrate those workloads over as, you know, if you're interested in going kind of all in with Pure as a service. But yes, they do function, you know, independently from a procurement perspective, but you know, realistically, it's still, you know, part of your fleet that you can manage with fleet management in Pure One.
Right, that makes sense. Well, that is all the questions. I don't see any additionals coming through. So Josh, thank you very much for your time in the presentation today. It was excellent information. I do have a couple of housekeeping things here. So first, the Amazon gift cards, $20 gift cards, will be sent to you via email. So expect to see that coming pretty quickly. And then we will also be reaching out to everyone who attended today to see if anyone needs or wants a deeper dive on Pure as a service. We've got a team of experts, and with the Pure team, we can come on site or host a video conference call, whatever makes sense. But we'll be reaching out to everyone on the call to have that conversation as well. So that's it for today. Thanks everyone for attending our webinar. Everyone have